This is the Building Wealth Podcast with your host, Stephen P. Sitkowski.
Well, welcome everybody. Stephen Sitkowski here. This is my Building Wealth weekly podcast. Hope you had a nice weekend. It was pretty chill here. Ironically, it was chill because it was pretty damn warm and nobody wanted to go outside. It was triple digit temperatures. And when you live at 5,100 feet, that's a little bit unique. I mean, it certainly isn't out of the realm of possibility, clearly, because we had it. I taught a 2-day class Friday and Saturday, all day, both days on option trading. That was a lot of fun. And then yesterday, took in a couple of movies and hung out with the family and the puppy dog. But enough of what's going on here. We got to figure out what's going on with all of you and this kind of wacky market that we're dealing with at present. Sort of a battle between what's happening politically and what's happening with the profitability of these companies. But we're going to look at all that. It is July the 20th, year of our Lord 2026. A little bit of my history. I've been working with people and their money now for some 45 years. Had an opportunity to train, I don't know, I'd guess about 2 million people at this point. A whole lot. I still love the teaching aspect of this, which is why I do it. I don't have any other classes to teach today, so instead of just taking the day off, no, I couldn't do that. I'll come on here and, spend 30 or 40 minutes with you good folks. Because frankly, that's what I enjoy. I figure if I'm going to take the time to gather a bunch of information and do the research, why not share it with other people? Maybe you going out and combing through all the financial data to figure out what matters, maybe that's not your thing. So I'll go do that and kind of share with you the net conclusions that I come to. As a reminder, what we do here is for educational purposes only. It's not intended as investment advice. So even though I may talk about, specific companies or opportunities, I'm not telling you to run out and buy something or sell something, given the fact that I know absolutely nothing about your own personal circumstances. But these are just observations from me to you. So, what's moving the markets? So, I do this recording. It's about noon Mountain Time on the 20th of July. And the markets, they got shellacked on Friday and got shellacked for the week. By and large, we'll go through that. But the markets are up a little bit so far today. Nothing impressive. The Dow is actually down 220 points. So those are your big blue chip names. S&P 500, which is an index consisting of 500 large cap stocks, is up 0.8%. That's nominal. The NASDAQ, which of course would be tech heavy, is up 0.33%. The NASDAQ 100, those are the 100 largest companies traded on the NASDAQ, up 0.51%. So big tech seems to be doing better than tech generally. The Russell 2000 down a little bit, down 0.19%. So not exactly a consequential move so far in the market today. Well, what's moving the markets? Well, the U.S. continues strikes on Iran. So that situation is starting to feel like the war that'll never end, especially given the fact that it was announced that on a number of occasions that everything was winding down, that we were, you know, holding hands with Iran, singing Kumbaya, that an agreement was either in place or imminent, and none of that has turned out to be true. So I think that we have struck Iranian targets for the last 9 consecutive days. Now, there's a little good news. The foreign minister of Iran said, well, we think there might be a framework for a potential deal. Um, and how much weight do you want to give that? At this point, I'm just going to sit back and not try to predict what's going to happen and how that is going to impact the markets because it's impossible to do. I can tell you the markets, they're not buying it. When we look at oil prices, they're not suggesting that, hey, peace is right around the corner. That I can tell you. Semiconductors hit bear territory. So you know what that means? I mean, semiconductors as a sector are off their highs by a little more than 20%. Now, does that mean that those are stocks that you want to sell? Not necessarily. I mean, part of what's happened with the semis is they've moved up so abruptly and so strongly. At some point, you're just going to get a pullback. Here, let me try to explain this. Some of you are on audio only, some of you can see me on your computer. And when I use visuals, I will attempt to articulate those so that you get a mental image. But stocks, stocks will go up for a period of time and then roll over and then recover and go up and roll over. And why does that happen? Well, when a stock starts moving higher, it catches the media's attention, which catches the attention um, of other investors. And they don't want to miss out, right? So they start piling on. And as the buying increases, the price moves higher. But at some point, a stock will hit a price where people thinking about buying look at it and go, no, look how much the stock has already moved. And look at where the price is. The price has gone up 25% in the last 2 months. How much higher can it be? And for their own reasons, they conclude that at that point, there's more risk than potential reward in buying the stock. So the buyers start to shrink, volume starts to come down. And then the people who own the stock start thinking, well, it looks like the gig is up. Maybe we should go ahead and sell and take profit. So it's a combination of fewer buyers and more sellers that then will cause this stock to roll over and it'll move down. And with most companies, it'll ultimately hit a price at some point, sometimes sooner than later, where it looks like a good buy again. And then, the people start purchasing. We call that buying the dip, which is a fantastic strategy given the fact that the stock market always goes higher over time. Never forget that. It's been doing that for 120 years. So if I'm looking at something and I know the price is going to go higher, would it make sense to buy it when I can get it on sale? Absolutely. And this cycle just kind of repeats itself until, and it's assuming that this happens, that the fundamentals on that business change. Now, if the fundamentals change, well, then all bets are off. If all of a sudden some technology gets developed and it's better than what's out there now and it's cheaper, is that going to hurt a company that's been a leader in that space for years? Of course it will. But in the absence of that, you're going to expect highs and lows. New buying creates new highs and so forth. So the semiconductors are engaged in a pullback. Are they going anywhere? You think chip manufacturers are suddenly going to go out of business? No. All three indexes closed in the red last week. That's the Dow, the S&P, and the Nasdaq. A lot of volatility last week. I think part of that certainly has to be attributed to what's going on in the Middle East and the news that gets released relative to that conflict slash war. 10-year Treasury is up. It's at 4.582. So whenever the 10-year Treasury goes above 4.5, the market doesn't like that so much, right? The market likes low interest rates. So low is obviously a relative term. Below 4%, oh, they're in love. 4 to 4.5, that's good. 4.5 to 5 is not great. And since interest rates have gone up, driven by the fact that oil prices have gone back up, which also isn't good for the market, the markets have pulled back. If the 10-year Treasury goes above 5, which I do not expect that to happen anytime soon, then the market would probably pull back 10%. That's my best guess. So my near-term hope is let's get this rate under 4.5. If we get oil prices down, that will naturally happen. And oil is now at $82.45 a barrel. Now, 3 weeks ago, we're at 68. So, I mean, this could come down dramatically in a relatively short time if we legitimately get a deal in place with Iran and if that deal sticks. See, that's the other thing. You can't make a deal. Hey, we're going to have a ceasefire and then bomb somebody the next day. That's what's been going on. So that's what's moving the markets. That's what I'm predominantly keeping an eye on at the moment. Last week's market breadth. So the two things that we look at are advancers versus decliners, new highs versus new lows. And we're going to take a look at the New York Stock Exchange and the NASDAQ. So on the NYSE, you had 1,508 stocks that moved higher, 1,325 moved lower. So that's fairly solid. The problem is some of the stocks that moved lower moved much lower. And then if you look at the number of new 52-week highs versus 52-week lows, that was just fine. 296 new highs, 119 new lows. So all of that spells out a bullish market. The NASDAQ was a different picture. Now, these are the companies that were more the high flyers, where people started taking profits. We had 2,007 stocks move higher, 3,162 moved lower. And you look at new highs, 445, new lows, 510. So the NASDAQ looked more bearish, but not necessarily bearish. We didn't have an overwhelmingly, large number hitting new lows versus new highs, but it is certainly worth noting, and if it was the reverse, again, worth noting. Now, there are times when I have seen 800 stocks hit new lows and maybe 70 hit new highs. That's when you know the market is being completely sold off. That's not what's going on here. Sector rotation. So if we look at the last 6 weeks, going back to June 1st, now, those of you that have been faithfully watching, you've heard me bang the drum on what sector? Financials. What have I told you about financials? They're trading at low multiples, they pay a nice dividend, and would represent a fairly safe haven. And they didn't do anything for a while, and I wanted to kick them in the rear end to go, hey, listen, I'm propping you guys up. How come your stocks aren't going higher? But in the last 6 weeks, it's up about 10%. So it's about probably where it ought to be. Might it still represent a value play? A little bit, but not like it was previously. Next on the list was healthcare, up 9.1%. So financials and healthcare, which have lagged year to date, suddenly took the lead for the last 6 weeks because that's how the market moves. Kind of goes back to that cycle that I was describing to you. Something goes up, 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 whether it's a stock or a sector, and ultimately it gets to a price where the average investor goes, I think that might be getting too high. Buyers slow down, sellers kick in. And then as the sellers kick in, they need to take that money and put it somewhere. They don't want to put it in a savings account making 0.6%. So they pick another part of the market. And what they've picked were financials and healthcare for the last 6 weeks. Utilities have overperformed, so have REITs. Industrials are holding strong. That's been a good sector all year. So, what was at the bottom of the food chain? What used to be at the top of the food chain? Technology. Tech stocks were down 8.7%. And we've seen some tech stocks that have made big moves to the downside. Earnings looking strong. So we're expecting the average S&P 500 company to report an earnings increase year over year of 24.7%. It's fantastic. They say earnings are the mother's milk of the stock market. So as long as earnings climb, everything else being equal, one would expect stock prices to climb. That's what's been happening. Now, here's a little different look. If you take Micron Technology and Nvidia, their forecasted earnings out of the picture, then the return on the S&P 500 in terms of earnings growth drops from 24.7 down to 16.8, which is still very, very good, but it's not a monster number like 24.7. Now, having said that, let me say this. Micron and Nvidia damn well better deliver. If they don't, they can skew this whole thing and take the market with them. I do expect they're going to deliver, by the way. Last week's heat map. So when you kind of look at this, right, step back, take a gander, look at red versus green, you're like, it looks about like a push. And on the S&P, basically, it was about the same number of stocks going up as stocks going down. But when you look at where the bright colors were, those are bigger moves. Um, on the downside for red, Tesla down 6.6, Broadcom 7.29, Micron Technology down 13%. Now you might say, oh, does that mean it's time to get out of it? No, Micron is up year to date over 200%. I mean, I follow Micron pretty carefully. It's up today. I follow it because I own it. Um, Intel down 13%, AMD 11%. Having, a bunch of stocks, big companies, fall more than 10% for the week, kind of a big deal. SanDisk down 29%. Now, year over year, SanDisk was up over 600%. Big winners, well, outside of energy, which I don't pay much attention to because that's all war driven, Apple had a lovely week, up 5.84%. I've got call options on Apple, so that's music to my ears. Palo Alto Network was up 10.5%. CrowdStrike up nicely. So there were some big winners and big losers, more big losers than big winners, however. So semis are getting hammered. So these are your chip makers. And this shows the drawdown from their max profit, 20.1%. kind of a big deal, but we've been here before. I mean, that happened in 2022. It happened in 2025. And in both times, this sector rebounded and moved higher and made new all-time highs. I mean, let's face it. You want to do AI? Yeah. You got to need semiconductors? Of course you are. So they're not going anywhere. ChatGPT, all the rage. So you can see that the adoption, the number of people using ChatGPT has grown faster in a couple of years than the internet did in 13 years. Is that insane? And I read somewhere that about 2.5% of the US population is paying for some form of AI. So think about that. They've penetrated 2+% of the market. There's 97.5% ready to get tapped, and they will. What percentage of the population is using the internet? Right? Damn near everybody. Housing starts. I don't know where this came from because mortgage rates on a 30-year fixed are still running 6.6-ish, but housing starts had a big pop up to 1.43 million. The previous month, it was just a fraction of that. So all of a sudden, the builders got on board and started feeling like, now that could have been because they thought that we had an end to the conflict in Iran and that interest rates were going to be coming down. So then they jumped in, and we'll see what they do next month. Consumer sentiment had a little bounce. It's now at a 5-month high. I wonder what that would look like if that survey was done today. So this is always looking back the previous month, but when people feel good, lots of great stuff happens, right? They go out and look for jobs, they make investments, they spend money, they stimulate the economy. So, no, that's awesome. Market sentiment. So this was done on the 15th. I suspect the next one is not going to look so rosy. So on July the 15th, when the American Association of Independent Investors were asked, you think the market's going up or down over the next 6 months? 44.9% responded up, 32.9% responded down. Compared to historical averages of 37.5 saying up, 31% saying down. So normally the bullish outrank the bearish by 6.5%. Well, now they outrank them by almost 12%, by exactly 12%. Now, next week when this comes out, it's going to be a different story. That I can tell you. The Fear Greed Index, which gets updated daily, we are now almost smack dab in the middle of fear. So we have extreme fear, fear, neutral, greed, extreme greed. We're in fear. And I think that is appropriate, albeit I am bullish. I do believe that the market between now and the end of the year will go higher. Why? Well, a couple of reasons. Number one, I do think there'll be an end to this war. And number two, earnings. So if earnings are robust, we get an end of the war and interest rates start coming down, we might have another 10% to the upside. Wouldn't surprise me. Future of interest rates. Well, because we got a spike in oil prices again, the interest rate picture has changed. So last week, we were forecasted to have one rate increase between now and December of 2027. The present forecast is for a rate increase in September. Last week, we weren't expecting a rate increase till either October or December. So they've moved that up. And then a second rate increase is anticipated in March of next year. So now we're looking at two rate increases. Now, this is very dynamic. It changes literally on a daily basis and throughout the day, but it is something I keep an eye on because Wall Street keeps an eye on it. Sector price performance year to date, S&P is up 9.11%, pretty solid for half a year, led by energy. I'm going to throw that out because that's all war driven. So then who besides energy are the leaders? Technology up 15%. Fantastic. That's where the bulk of the earnings are coming from. Industrials up 15%. That is data center construction. REITs are up 13%. Materials up 9.13, so that kind of equals the S&P. Staples up about 9%. And then everything else lags. The only thing, where is financials? So financials are now positive on the year, up 2.37. The big laggard is discretionary. It's off 2.22%. So discretionary stocks, these are companies that make stuff we all want but don't need. Um, those stocks flew last year. And now people are starting to get a bit concerned. Interest rates are higher, financing costs are higher, and I wouldn't be jumping into any of those. I'd let that sleeping dog continue to sleep. This week's earnings. So, what do we have that might move the market? Today, none of that's going to move the market. I mean, the biggest bank is Zion's. Is that going to move the market? No. Tuesday, you got 3M. I don't see anything else on here that's a market mover. On Wednesday, now it starts to get a little interesting. You have Alphabet, you have Tesla, IBM, Texas Instrument, and then CSX, which is the railroad company, sort of a litmus test for the economy. That's going to be a pretty interesting day. Thursday, we get Intel. I don't see anything else going to move the market. And Friday, yeah, no market. Well, American Express. American Express, we'll get some insights into the consumer from that call. So Wednesday, Thursday, Friday could have heightened volatility depending on how these earnings calls go. Um, Data that's coming out this week for you to watch. And again, I just focus on things that I think could move the market. Today, nothing. Tomorrow, nothing. Wednesday, there are no events. So Thursday, we get our weekly jobless claims. So they came in last week at 208,000, which was fantastic. We're expecting 215,000. So this next week, the forecast is 212,000. And on Friday, we get our flash manufacturing and flash services numbers, which let us know sort of how the economy is moving. So not a particularly busy week when it comes to news. So probably the biggest news is going to be whatever the earnings announcements are. All right, let's take a look at the charts. So I'm going to, for those of you who are in audio only mode, I will describe them for you. So I'm going to pull up, first of all, a chart. By the way, Remember me coaching you on SpaceX? What I told you I thought would happen? It'd go zooming up out of the gates and then it would pull back. Let me just pull up just because it's on here. That's not SpaceX. Um, let's type it in. So it hit a high of 225. Since then, exactly cut in half at 122.50. And you can see over the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 13 trading days, 11 of them have had red candles. So after it made its little move up, this thing has basically gone down ever since. And it was kind of what I expected. I wasn't hoping for it. I'd have rather been wrong because I know a lot of people put their hard earned money in there. Now, listen, we're early in the game on it. But my recommendation was let it go public and watch it for 6 months. Right? And now you see why. All right, so on the S&P 500, we are looking at a 6-month chart. Um, First thing that I will observe for the first couple of months here, back in January, February, we were moving sideways. Then war broke out and the S&P fell precipitously. Then we had the ceasefire that never stuck, but it rallied the market, and the market moved up, hit a high of 76.20, and then it have a pullback down to the 50-day moving average and move higher, and a pullback to the 50-day and move higher, and now we're sitting right on the 50-day again. So the question is, are we going to move higher? And I think combination of earnings and Iran was going to answer that question. So we're going to have to kind of wait and see. Also, as I look at the chart, for those of you who can see this, I'm going to draw the upper and lower trend line. So there's the upper trend line, and here is the lower trend line. And we are forming a wedge pattern. And normally, when the highs are getting lower and the lows are getting higher, right? There's a wedge that takes place. That is what's known as a breakout pattern. So we can anticipate a significant move either to the upside if we cross above the upper trend line, or lower if we cross below the lower trend line. So that's what's happening there. Okay, so I'm going to go back to the chart and I want to talk to you about, based on your request, how do I find levels of support and resistance? So let's begin with the question, well, what is support and resistance and why should I care? So picture support like a floor, right? That anytime the market comes down to that floor, it tends to bounce and go higher. And imagine resistance as a ceiling, that the stock will go up until it hits that ceiling and then it starts to fall. So it becomes a fairly predictive buying and selling range. So if you're looking at a stock on a chart, and you saw that every time the stock got down to $50 a share, it moved higher, what would you do when the stock was at 50? You'd buy it. What is your buying and the buying of millions of other people cause the price of that stock to do? To move higher. Becomes a self-fulfilling prophecy. And then let's say you notice that every time the stock got to 70, it would roll over and start coming down. So when the stock approached 70, what might you do? Sell it and take profits. And that collective selling causes the price of the stock to come down until what? It gets back down to 50. And so I wish that it worked that perfectly in the real world. But I am telling you, every trader who knows anything about trading watches levels of support and resistance, and it triggers buy and sell zones. That's why you want to pay attention to it. So the question is, how do you find it? It's actually very simple. And I'll do this on a handful of charts. So if I'm looking at right now the S&P 500, basically I'm going to draw a line at the level where this stock retreated the last time it was reached. Now, my my hope is that these levels have more than one touch point. Two is better. Three means this is a very strong level with a lot of validity. Well, if you look at this chart, and it doesn't have to be exact, right? It can be kind of a range. But right in this range, we notice that the stocks tend to pull back. So before I would get overly bullish in my outlook, I need to see the stock break through that level of resistance. Right now on the S&P, we have fairly weak resistance, but we definitely have resistance. So let's go through, I'll just randomly pull out a few charts. So kind of the same thing here on Broadcom. It made this huge move to the upside, got to 493. Now it's at 382 and made a big drop. So we have broken through. Now, this is very important. With Broadcom, we have broken through previous levels of resistance. So there is a level of resistance for Broadcom at 439. We broke through that, right? So when it breaks above, old resistance becomes new support. And then it broke through that support level, which now becomes new resistance. So as I kind of drag this down, if one was to ask me, where do you see current resistance on Broadcom? Right here at about 410. The stock's at 382. Now, the support level on this is a lot easier to find. So I can come down here and see 1, 2, 3 touch points recently, where every time it got down to about 360, the stock bounced higher. But as of right now, you got a pretty narrow gap between support and resistance, which doesn't make it very attractive, candidly, for somebody looking to pick a bounce. It's fairly attractive for doing a spread trade. So if you wanted to find a level below which this stock wouldn't go at about 360, you'd be in really good shape. But we're just talking about finding these levels. Here, let's do Nvidia. So, current level of support on Nvidia is going to be like right here, and that's a very strong level at between 190 and 195. The stock's currently at 204. So, would I be willing to make a bet that Nvidia is going to stay for the next couple weeks above 190? Absolutely. Great setup for a spread trade. Now, where do we see current levels of resistance? Right up here, where I've got multiple touch points. One, and then this old support level would be two, this area here, three, this area here, four. And where is that? Around 215. So Nvidia is trading between 190 and 215. Get down to 190, you wanted to do something bullish, that'd make total sense. Get to 215 and you see it hesitate, close out that bullish trade. Let's do one more. Here's Meta. Meta's been taking a little bit of a beating, but started to make a comeback. All right. So where do I see current resistance. I've got a couple of touch points right in here, which would be about 685. The stock is currently at 648. So I actually have one, two, three, four touch points. A lot of validity to that. Where do we have support? Well, support looks like there's the current price of the stock. This is a messy chart. Um, I'm probably looking at support at about 635. So it's kind of sitting between support and resistance. So if you can see the chart, over in this area, multiple touch points right here, multiple touch points, multiple touch points. And you can see recently the tail came all the way down to that touch point again and moved higher. So what you want to be looking for, and I'm going to show you a little trick, are places where there are multiple touch points for either support or resistance. So let me pull something else out. Let's look at here, Palo Alto. So one of the things that I will do is I will simply put a horizontal line at the current price of the stock. So on Palo Alto, when I do that, stock's at 360. I notice that there are multiple touch points recently right there. So Palo Alto is sitting right on a resistance level, which is awesome. One of two things are going to happen. It'll break through, and then that stock's going to run, or it's going to pull back. And where would it pull back to? More than likely the last level of resistance, which is 320. So I would be waiting to see, you going to break through? If you don't, you're probably coming back down to 320, and I could take a trade based on that. So thank you for that query. Let me give you my email. So if you want to send me a stock to look at, a question that you've got, or like in this case, a topic you'd like for me to cover, send it to Steve Sitkowski. That's STEVESITKOWSKI at gmail.com. All right. What I'd now like to do very quickly is I want to share with you some of our recently closed trades. So my partner Pam and I do trade ideas of the week. So on any given week, we'll put out 2 to 4 trades, and I'll tell you how to get those in a second. So these were 2 of the 3 we closed last week. The other one we closed at a profit as well. I just don't want to overwhelm you with stuff. So this was on TJX. It was a call spread. We were betting that the price of the stock would not fall below 150. So we closed this trade out July 17th. We took a profit of 14.8% in 9 days. So anytime we're making more than 1% a day, I'm pretty happy about that. And then on John Deere, which actually at one time we were down on this trade and we had to make some adjustments to it and close this out on July 17th at a profit of 34.4% in 17 days. Pretty sweet. So if you want to see and learn about that service, you can go to tradeideasoftheweek.com. And there's a little video that describes it and an enrollment page if you're so interested. Only do that, by the way, if you understand options. What a great session. That was a lot of fun to do. Probably because we had a lot to talk about. We're going to have a lot to talk about next week as well. I sound like Mr. Rogers. We'll have lots to talk about. You will too. All right, guys. Well, I will see you next week. Until then, be safe, be blessed. Bye for now.